Welcome to MarketTamer.com. We're looking at the S&P 500 coming into the end of the trading day, about 10 minutes or so to go to the end of the trading day. Market has been fairly flat all day, just holding above its 5-day moving average. So the bullish trend is still firmly intact, and what we'll do is, as a result, take a look at something else. And what I'd like to discuss today is Jim Rogers' view on shorting the market. Historically, he has had a history of shorting bear market rallies, but at this point in time during this bear market, he's decided not to short the market. And this is particularly interesting in the context of some of his other viewpoints. For example, he is bearish on the economy, he's bearish on the dollar, and he's bearish on the bond market. So why would he refuse to go short the stock market? Well, to answer that, let's first take a step back and understand his history. He has a history as a fundamental analyst. He looks at macro issues. He's obviously worked with George Soros before as part of the Quantum Fund. George Soros, the man who made over $1 billion last year. And Jim has a history of making macro calls and sticking rigidly to them once he believes they will be justified and vindicated in the end. He's not so much a day trader, not a technical analyst, not a trader on a weekly or monthly basis. He makes long-term calls and sticks with them. So in spite of a commodity correction, for example, he's still very bullish on commodities. So let's return now and think, why would he be refusing to short the market in the context of these views? And the answer is what we described back in March as a paradigm shift. There's more money, being printed than ever before. And so what that means is prices are likely to rise to reflect the value of goods and services. So can the stock market rise in nominal terms to reflect the increase in money supply? Absolutely. In fact, this is his point. This is why he's refusing to short the stock market, that with so much money being printed, he is not convinced that in spite of the technical weakness and fundamental weakness that we have seen in the past year, that the market will not rally. In fact, he said, hypothetically, theoretically, with so much money being printed, there is a possibility for the Dow to rise very, very substantially. He even threw out figures that would seem almost unbelievable at this point, such as 20,000 or 30,000. And as we look at this, as we analyze this, we might say, is this a good thing? Would it be good for the market to rise to 20,000 or 30,000? Well, as obscene and unbelievable as it might seem, our initial reaction would be, wow, that would be great. We'd take advantage of that. We'd jump in. We'd be bullish. We'd make a lot of money. But there's another factor to consider before making a quick judgment, and that is, how far will that money go? And to discuss that further, just think about the situation when you would buy bonds. You receive from the government a guaranteed payment, and the government promises you a payment of dollars. They do not promise you how much you can spend or how far those dollars will go. So you get no guarantee on purchasing power. You do get a guarantee on a dollar figure. So let's say today that figure is 5%, or let's say a coupon rate of 5%, and you're guaranteed $50 payment. Well, you might say that's okay based on whatever you'd invested. Maybe it's a reasonable rate of return for you. But in the future, if you receive that $50 and that $50 goes half as far, obviously that's not really a good deal as far as you're concerned. So that's something we have to pay attention to when we're looking at prices rising. Are prices rising in nominal terms or real terms? Are prices rising because goods and services are being produced? Is there organic growth, or are prices rising because more money is being printed? And finally, we might ask, well, why focus on dollars? Why this emphasis on the big picture here? And the reason is it just simply affects everything. It affects food, goods, services, transportation. It affects domestic government policy, the potential introduction of a VAT tax. It affects international policy. Will China continue buying bonds, for example? And it may even be used as a predictor of a paradigm shift. There may be increased market volatility, and we should be able to prepare for that as a result. So if you have any more questions on this, please don't hesitate to come join us at MarketTamer.com, and we'll be delighted to answer your questions. Have a wonderful weekend.